guys, welcome to the Treasury Update Podcast Coffee Break Sessions, the show where we cover foundational Treasury topics and questions in about the same amount of time it takes you to drink your coffee. This is your host, Alexa Cook, joined today with Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome back, Craig.
Hey, it's good to be here again, Alexa.
Thanks for joining me. So today we're going to just jump right in and talk about intercompany loans. So could you maybe start us off by covering what are intercompany loans?
Yeah, intercompany loans are loans between related companies or entities in a corporate hierarchy.
Within a corporation or a company, are there any rules or any requirements that they need to have on these intercompany loans?
Yeah, there's going to be some rules or requirements from a governance perspective within an organization, but there's also some external regulations. I know that's beyond the scope of this coffee break session, but there would be rules to document these loans contemporaneously. So when they're done, they need to be documented and captured as opposed to just an informal setup in a system. And so the documentation needs to include all of the key loan terms, and it should reflect a reasonable or defensible market rate for the loans based on the entity. So that's all part of doing this, contemporaneously, not papering this after the fact to support activities that were done in the past, but to document them when the loan is going to occur.
Okay, so you kind of answered one of my questions, which was going to be, are there, any terms on those or how are those interest rates or rates determined? But what are some of the typical durations on these intercompany loans, or does that matter? Can they be anything?
There's different things that can guide an organization to make it, termed less than a year, sometimes longer than a year, or something that continually rolls. There's a bunch of rules for that. So, I think we'd just say that there's a lot of variability based upon what the needs of the organization are and some of the governing regs.
Why would companies elect to use intercompany loans?
Yeah, so using an intercompany loan, there's a number of reasons, and it may be for some or all of those reasons. So one is that it's oftentimes used, it simplifies liquidity matters. You have a entity structure, you have a bunch of entities in your legal entity tree, and certain organizations need liquidity, and you don't necessarily want to have lots of loans. You have 20 entities and 10 of them need cash. You don't necessarily want to have 10 loans with third-party banks to support that. You may have a central loan that allows you to simplify moving your needs around within your entity hierarchy. And so this fewer loans means less work to support that. It also usually means a reduction in the overall cost to borrow. Typically when you're borrowing from your most highly rated entity. And then while you might lend to a subordinate entity at a market rate based on their credit situation, your overall company, group of companies, costs are going to be lower by reducing this overall cost to borrow. So that happens because of better rates. It also happens because, if you had to borrow for each entity individually, you'd probably borrow more than was necessary with each one, which means in total you'd be borrowing more at higher rates. So intercompany loan simplifies liquidity quite a bit. And the other factor why it helps is needs for liquidity can vary over time across the enterprise. Certain companies may have different cycles of liquidity needs. And why borrow externally if you can support it, maybe even from extra cash that's thrown off by other parts of the organization? So there's a lot of real good benefits for intercompany loans. They're not terribly difficult to manage, and they usually have significant financial benefit.
Absolutely. It certainly sounds like it. So you've talked about a lot of different ways that these are kind of being done. So have you seen or I guess recommend that companies put a limit on the number of intercompany loans that entities are involved in, or or does it just really kind of vary by company size? I mean, could one parent have like 25, or is that too many, or is there a set number, or what is your take on that?
Yeah, I think the broader answer to your question is, or the broader statement in response is that, complexity is not our friend. Why have a supremely large number of intercompany loans when a fewer number will do? And so you're trying to reduce complexity. So that's a general guideline. When you think about how many intercompany loans entities are involved in, I would also answer it this way. So if you have 20 entities, you could potentially have, 20 factorial, everyone lending to someone else in that mix. You may have a central entity that lends to the others, and it does, one has a loan relationship with the other 19. And so it's definitely easier to simplify the number of loans, but 19 may not be enough in the case that I listed. There might be some other situations where entity 5 and entity 10 also loan to another entity, but simplification is a good direction to head to.
Yeah, and I think that's really good just in the broader sense of treasury too, that complexity is not always your friend. So I really like that. Another question, I guess, that has kind of popped up is, are loans typically from a parent entity to, I'll call it a child entity, or could they be done the other direction from the child entity then upwards to the parent?
They can be done either way, but your question about, are they typically done? Typically, they're done from farther up the entity hierarchy to children or children's children in the structure. That's how they often run, but there's not a restriction. There's not a restriction per se between other entities. There are some things you have to be careful with. So talking to your tax advisors and your legal advisors is warranted there, especially as we get more complex with intercompany loan structures.
So then in thinking, are intercompany loans ever used to move money cross-border?
That's a great question, Alexa, and it is a little bit more involved because it involves sometimes different currencies and greater considerations on the tax side. So the broad answer is yes, but there's certainly a lot more nuances, and I know you've been involved in a number of ICLs and companies you've worked at, and with some of the work we do.
Right, and that's, of course, looking a little more strategic than these podcasts typically tend to dive into. So we can maybe close it off there for today. So I'll just do a quick recap on everything. So just in short, intercompany loans are typically loans between related companies, and you just have to make sure that you're documenting the terms. This is super important. They're typically using the market rates, and any of the details, or whether it's the terms, the durations, or anything in there, really can vary between the companies to fit each entity and what's appropriate. And it's a big use or driver for using these intercompany loans is that they're used to really simplify the liquidity matters. And I think that you said that complexity is not always our friend. And I really like that you said that, because I think that's just really a broader treasury sense that we can kind of keep in our back pocket as a tool. Yeah, well, thanks for joining me today, Craig. And to all of our listeners, make sure you join back every first and third Thursday of the month for a new podcast. And as always, we love to hear your comments and feedback. So you can send us an email at podcast@strategictreasure.com.
This podcast is provided for informational purposes only, and statements made by Strategic Treasure LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.